Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Hi, and welcome back to ETF Market Insights. I'm Erin Allen with BMO ETFs. And on today's video, we're going to be talking all about gold. So we'll definitely be reviewing the case for building a portfolio and including gold as an allocation. But we'll also discuss the many different ways that you can access gold. That includes our new enhanced cash flow options. So an option strategy that can allow you to actually generate yield from your gold exposure. Before we do get into it, just a quick reminder that we're not providing investment advice or recommendations. Today is all about providing information and education. Joining me today, I'm really excited to have Jonathan Lau and Olivia Lee, both portfolio managers on BMO's suite of options-based ETFs, including our covered call ETFs. Thank you guys both for joining me today.
Thank you for having us.
Thank you for having us.
You guys both joined at the same time back in September 2024, if I'm not mistaken. But you're both bringing over a decade of experience in managing these types of options-based strategies. So a lot of experience there and two great newish additions to the team. But thank you both for joining me. I want to dive sort of right in and get into a conversation around gold. And Jonathan, maybe starting with you, kicking it off, can you walk us through some of the reasons or refresh us on the reasons why investors look to gold in their portfolios?
Yeah, well, thanks for having me here today. There are many reasons why it can be beneficial for investors to own gold in their portfolios. So traditionally, gold has a reputation to act as a safe haven asset during times of economic uncertainty. Or put in other words, gold tends to do well when the world is not doing so well. So I would say the first and foremost reason is that investors like to own gold to protect themselves on the downside. Now, this actually ties really well into the second reason why investors want to own gold, which is for portfolio diversification purposes. So historically, gold tends to have low correlation with traditional asset classes like stocks and bonds. And for investors that currently invest in stocks and/or bonds, adding some gold exposure into their portfolio mix can be an effective way to add diversification in their investment portfolios, given the low correlation with gold. A third reason why investors look to own gold is to protect themselves against inflation risk. As we have all observed in recent years, when inflation is high, it takes more dollars to buy the same amount of goods. And historically, gold tends to retain its value during these high periods of high inflation. And that's why investors tend to turn to gold during times of rising prices in order to preserve their purchasing power.
Very good. Thanks, Jonathan. So yeah, using it as sort of a hedge in their portfolios in a lot of different cases. And I think just the general fact that portfolio construction has needed to evolve, like we've seen fixed income and equities becoming more correlated. We have to be including some of these alternative asset classes in a portfolio to get that diversification that's so important. So good points. Olivia, what are the key differences? I mentioned off the top sort of those three different ways we can access gold: through physical gold, through producers, gold equities, and with the new cash flow option. Can you get into a little bit in terms of the differences and maybe, why one might look to one over the other?
Yeah, so at BMO, we have a full line of ETFs that provide investors with different exposure to gold, but with different risk and return characteristics. And the first one is most straightforward, is physical gold, and that is our ZGLD, the BMO Gold Bullion ETF. And with that ETF, investors will get to have access to physical gold, but without the hassle of having to buy it and then store it. And the value of this ETF is directly tied to the price of gold bullion in CAD terms. And the physical gold bars are stored in a vault in Toronto. And the risk rating on this particular ETF is medium. Then another way of accessing gold exposure would be through gold equities. And at BMO, we have two ETFs for that. So we have the ZWGD, which is the BMO Equal Weight Global Gold Index ETF, as well as the ZWG, which is the BMO Junior Gold Index ETFs. So both of these ETFs are portfolios of gold companies. And with gold companies, investors are really investing in the profitability of these companies beyond just getting exposure to the price movements of gold. So with that, there is some potential equity appreciation and some potential additional upside in addition just to the price of gold. And with that, because there's a higher potential for return, the risk is also higher. So the risk rating on both of these ETFs is high. So the third and newest addition to our gold lineup at BMO is gold with cash flow, and that is ticker ZWGD, the BMO cover call spread gold bullion ETF. And we really designed this ETF with the income-oriented investor in mind. A lot of investors would like to invest to have gold in their portfolio, but gold, as we know, is a yieldless asset. So for income investors, they might find it difficult to include it in the portfolio. So when we designed this product, we aim to offer investors that consistent monthly cash flow, but also preserve most of the diversification qualities of gold.
Great. So there's really something for every investment objective at the end of the day. And I think BMO has really sort of filled that maybe final gap. We'll see. Maybe there's another need that we don't know about it yet, but this does feel like we've filled a gap, and now we can really target any objective and give people exposure to gold. Jonathan, let's get into ZWGD, the gold spread solution. Can you talk a little bit more about this product and why BMO went the covered call spread route for it?
Yeah, sure. So the BMO Cover Call Spread Gold Bullion ETF is the first cover call spread product in Canada as far as we know. And we're really excited to see these new innovative products like ZWGD come onto the BMO ETF shelf for our clients. So the ETF was launched about a month ago, and it has actually just paid its first distribution. In terms of how the cover call spread strategy on gold would work, we begin by owning our gold bullion ETF ZGLD, and then we write out of the money call options on about half of the gold exposure we own to generate monthly cash flows. Now, for those of you who are already familiar with our cover call ETFs, this first part works similarly as our existing cover call strategies. And then on top of this, then we add an additional twist to make it a cover call spread. We purchase an additional call option that is further out of the money than the one we just sold. And this selling and buying of call options is what makes it a cover call spread. Now, as far as why we decided to go with a call spread for gold specifically, I would go back to the reason why investors wanted to invest in gold in the first place, which is to protect themselves against the downside during times of uncertainty. It could be when markets are down or when inflation is up. So our view is that investors want to retain strong upside in gold when the world is really not doing well. Now, historically at BMO, the main focus of our cover call ETFs has been in equities, and the cover call strategies have worked well when the underlying is in equities. So when we were designing a product for gold, we took a careful look at the historical monthly return profile for gold. And what we observed was that when compared to equities, gold's historical monthly return tends to be more frequently muted, but it does come with occasional spikes of strong performance. Now, given that gold behaves differently than equities, and after all, it's a different type of asset, it naturally makes sense that the option strategy should also be different. And in fact, we view our covered call spread strategy as a natural evolution from our existing suite of covered call strategies. So in summary, our view is that when investors wanted to invest in gold, they want that tail protection. So by buying that second further out of the money call option, we're able to maintain that linear upside in gold when gold rallies a lot. And that is why we believe that a covered call spread is the most appropriate strategy when it comes to gold.
Very good. Thank you, Jonathan. I think it's, BMO's obviously a leader in covered call ETFs. We've been at it for over a decade with the largest suite on the street here. So it does feel like a natural evolution or an innovation in the space that we're the natural person to be bringing this to market. Olivia, maybe you can walk us through a little bit more into the weeds in terms of how the strategy looks and how it differs from our traditional covered call strategy as well.
Yes, for sure. So let's take a look at a numerical example of how we put this strategy together. So first, we own the underlier, and in this case, it's going to be ZGLD, our physical gold bullion ETF. And for simplicity's sake, let's just assume that it's currently trading at $100. So to implement a cover call spread, first we sell a call option at a strike price of 101. Now that is fairly close to the money, so it's going to be a little more expensive, and so we can collect $1.50 for that. Then we buy a call option at a higher strike. In this case, we'll buy back at a strike of 103. Now that is a little bit further out of the money, and so we don't need to pay too much for it. We only need to pay 50 cents for that. So net, we've sold a call option at a lower strike and then bought back a call option at a higher strike for a net option premium to collect of a $1. Now that $1 option premium we've collected is how we're generating cash flow on the gold strategy. Now, with any type of cash generating strategies, it's going to change the underlying return characteristics a little bit. So let's take a look at its monthly payoff structure. And also at BMO, what I just described is a fully covered cover call strategy, but the BMO methodology is that we only cover 50%. So here's a look at how it looks on our cover call spread strategy using BMO's methodology. So because we have two different call strikes, that is going to divide the monthly payoff structure of the underlying into three zones. The first zone would be under the first strike, which is the 101 strike. Under that strike, the option premium that we collected can act as a little bit of a downside cushion or an additional alpha if the underlying is flat during the period or if the underlying is down during that period. And this experience is very consistent with how it looks with other income generating strategies using maybe a covered call. And then the second zone of return will be between the two option strikes. So that would be between strikes 101 and 103. In this zone, we at BMO call it the speed bump zone or slowdown zone. And in this zone, the ZWGD's participation with ZGLD is going to be only 50%, and that is getting a little bit of a slowdown. And this slowdown zone is what investors are trading off of in order to get that option premium and that current income upfront. And then finally, once we are past the higher strike of 103, ZWGD is going to perform linearly with the underlier ZGLD. And this is a very powerful characteristic of our cover call spread strategy, because for gold, as Jonathan has mentioned earlier, it is very important to retain that upside, and having this call spread strategy allows us to have linear exposure to the upside to gold. Now, if I were to just make an analogy of putting these three strategies together, first is the actual underlier on its own, then is a traditional cover call strategy that's fully covered, and then finally our BMO methodology of a cover call spread. Let's pretend that they are in the race. Their upside experience is in a race. Then the ZGLD is going to continue forward at a constant speed. The cover call strategy is going to be stopped out at that first strike price. And then our BMO cover call spread strategy is going to hit a speed bump in between 101 to 103, but then continue on with the same speed as ZGLD going forward.
All right. So it's still going to finish the race, but it's going to come in behind ZGLD.
Yes, but on the upside is going to continue at the same speed. And we think that when gold really takes off, our strategy will be not far behind it as well. So that's why it's really unique in that sense. And then finally, I should also mention that I've been talking about the strike prices 101 and 103 in my numerical example, but this is not fixed in the way how we actually implement it in our portfolio and in real life. It is going to be a function of volatility. And in general, the higher the volatility, the higher the call strike prices. So both of the options that we implement in the call spread are going to move higher when volatility is higher.
All right, Olivia, and now sticking with you, can you talk us through how this strategy would behave across different market cycles relative to holding the physical gold?
Yeah, of course. So we just gone through a monthly payoff structure of how our cover call spread strategy will work. And in general, is going to translate into overall bear market as well as bull markets as well. And we believe that this product would deliver what income-focused investors look for when they want to include an income and gold product in their portfolio. So generally, when gold market is down, the cover call spread strategy is going to outperform the underlier gold. And that's because we collect that option premium by selling that call spread. And that acts as a bit of a downside cushion. And so the outperformance is going to be by the amount of the option premium that we collected. And on the upside, especially in very bull markets, as we talked about earlier, the cover call spread what's special about it is that it's going to limit the underperformance on the upside. So any cash flow generating strategies, investors are making that trade-off between receiving current income and giving up some growth. And more traditional cover call strategies, that performance on the upside is going to lag the further the underlier goes. But for our cover call spread strategy, that underperformance is just limited to the strike distance. And in my example I talked about earlier, it was 101 to 103. And because at BMO we only cover 50% of that portfolio, it's only going to be about 1% and less, and even so less the option premium that we get to collect as well. So that's really powerful, which means that in a really big bull market for gold, it's going to follow and have a really strong link to the upside with gold as well.
Perfect. And this product is a monthly pay product. As Jonathan mentioned, we did just pay our first distribution beginning of this month. So you can see what that's going to look like or may look like going forward. And similar to our other products, the goal is to maintain a consistent distribution, but also paying what we're earning in these solutions. But Jonathan, on the cover call solutions, we traditional cover call strategy, we often talk about the tax efficiency of that distribution. Can you walk us through, does this product have the same tax benefits as our other cover call ETFs?
The short answer is yes. So similar to our existing cover call ETFs, the cash flows that we receive from the cover call spread is typically treated as capital gains. So for investors that have a non-registered account, the cash flow that you receive would be taxed more efficiently versus an equivalent amount of interest income that is generated from a fixed income or GIC portfolio.
Okay, good news. And then maybe you can walk us through a bit more in terms of how one might look at portfolio construction considerations around this. Is this a replacement to your physical gold, or can it be used as sort of a diversifier within a broader allocation?
Sure. Maybe I can start with the income enhancement part. So one of the commonly known so-called disadvantages of investing in gold is that the fact that it doesn't pay or generate any income. But as you've heard earlier on the episode, we now have a gold-based solution that pays a stable monthly cash flow to our investors. So long story short, with the launch of ZWGD, we now have a strategy that basically has transformed gold from a yieldless asset into one that pays out a stable yield. Now, while at the same time, again, you continue to retain the diversification benefits like a traditional gold investor. So in your investment portfolio, you can now have an allocation to gold, but without having to sacrifice the yield aspect at the total portfolio level. Now, from a diversification standpoint within portfolio construction, historically, gold tends to have low correlation with traditional asset classes like stocks and bonds. So, having some allocation to gold can be a great way to diversify your investment portfolio. And for ZWGD, given that it is a covered call spread rather than covered call, investors can still retain that upside participation in gold when gold market rallies a lot, or maybe put another way, maintaining that strong diversification benefit when investment portfolios need it the most.
That's great. And the fee on this is 65 basis points, just like the rest of our cover call solutions, just to make sure our audience knows about that. Olivia, maybe you can close us out. And I know off the top you started talking about the ETF marketplace and what might be available out there, but are there other ETFs out there that give you a similar risk or a similar payout? And if not, like, what makes this one unique?
Yes, so for sure. So the cover call spread strategy is the first of its kind in Canada. For gold, there might be other income generating strategies out there, but they may employ a cover call strategy with different coverage ratios or different moneyness of the option that they may be writing. For us, what we find is that we've really done quite a bit of research when we are developing this product and really considering why people want to own gold in the first place. And what we found is that this cover call spread structure is what we believe is the most optimal in terms of delivering both income, delivering cash flow, and as well as that upside exposure to gold. So and in particular, what we really think is unique about this is most of the other income generating products out there, the underperformance on the upside grows as the underlier keeps going. And that is not going to be the case with ZWGD. That's really, really special there.
Fantastic. Thank you both for joining me today. It was a pleasure to get your thoughts on gold, and for sure important to get that overview of our new ZWGD ETF. I know a lot of investors were interested and are starting to receive some questions on it. If our listeners want any more information, they can go to bmoetfs.com and read about any of our gold exposures. So thank you guys for being here today. Remember that if you like this channel, to all of our viewers, please share with your friends and family and make sure you subscribe so that we can keep delivering this information to you on a regular basis. Thanks for joining us today. That's all for now, and we'll see you next week. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.